So welcome to tonight's session. It's the third part in our series, our Becoming a Trader series. And tonight's final piece is about strategy and risk management. Probably it goes without saying that if you've got any questions, please type them into the Q&A box. You should be able to see somewhere on your screen where you can type in your questions and your comments. It'd be great if you guys, got any comments about the market or anything that we're talking about. We always like to hear different people's opinions. It's kind of our job is to talk to our clients and have a back and forth with them. Equally, if you've got any questions, if you want any clarification, what we've talked about, you can type them in. If you think of something after the webcast, you wake up in the middle of the night, feel free to give us a call or email us, preferably wait till business hours to give us a call. But yeah, so give us a call or send us an email. You can always have a chat to myself or Tim, who are presenting tonight, or anyone else in the business about any particular topic. If you've got any issues, if you sound issues or video, whatever technical issues, you can just call the number on your screen. Now, for those of you who are kind of joining us tonight for the first time, you might be wondering who we are. You're hearing from Trader Circle, and at the other side of the business is Emerald Financial. Trader Circle is a business that's been around for quite some time and looks to help clients with their trading, right? The idea is to give them trade ideas, advice, to help them manage their positions and to educate as well. Emerald Financial is more for medium to longer term investments. We've got one of the best stock trainers in Australia, provide you all the fundamental information plus broker consensus, etc., on individual stocks so that you can make sound investment decisions. We also run an ETF portfolio. Traders Circle was established in 2005. Our sole purpose is to support traders, and that hasn't changed, right, over time. Our goal and our focus, our mission statement is to be traders that support traders, right? We became one of the busier options desks in Australia, and if you don't know what options are, you're going to find out more about that tonight. And we do run education courses for beginners all the way through to quite seasoned traders, right? We don't want to trade for you. It's not one of those operations where you kind of just give us your money and then we trade for you. We think the best trader for you is you. And if you've attended the last couple of sessions and after tonight, that should become a little bit more apparent as well. Our method is to simply teach you step by step how to trade the Australian market. We'll provide you with support, tools, and trade ideas, and we'll hold your hand as you transition to live trading. All right, so basically taking you from where you are now as perhaps a beginner or someone who's got experience but not really seeing the results that you're after. We'll teach you, we'll give you all the support, tools, personal trainers, mentors, and we'll hold your hand as you practice and learn until you're ready to basically start trading the live market, and then we'll continue to help you with your trading. Now, my name's Caro Cornips. That's a old, shocking photo. I've been meaning to change it, but myself, Tim, and the rest of the group are stuck at home at the moment, and the hairdressers aren't open. So I have an excuse at the moment, but I've been with the business for about 9 years now, I would say, 8 or 9 years. You kind of lose track of time. And I'm an advisor. I work alongside Tim, looking for trades, giving trade ideas to our clients, helping them manage their positions, give them advice, etc. But also, I'm also the head trainer. So one of my key roles is to actually mentor people who are coming through our education programs, make sure they're not making those silly mistakes that you're prone to making as a beginner, to help them paper trade and practice first and get good at all the principles, and then to help them transition to live trading. Tim is the head of the trading desk. So he's kind of like my boss and all the other traders here, right? His job is to oversee, but he's still in the trenches with us. He obviously still looks at the market, provides trade ideas, talks to clients, helps them manage their positions. But he has a lot of different fingers in the different pies, helping to kind of run the business essentially. Tim's been with us for about 8 years, 9 years, I think, around similar time. And he started as someone who came through our education. So he started as a client. He ran a few different restaurants, I believe, and wanted a bit of a sea change, came and learned how to trade, started trading, and then After some time, I think we offered him the job of being the trainer, which is, like I said, partly my job now. So between the two of us, we should be able to answer hopefully every question that you throw at us tonight. If we can't, we're very good at finding the answers very quickly, so we'll get back to you on them. But between us, there's plenty of years of experience, and we're used to not only trading, but also educating as well. Now, tonight's program is about trading different market conditions. We're going to explain to you the different types of derivatives we use, which are mini warrants and options, and we'll show you how to manage your trades. Last week, we ran through picking direction for any market. We ran through technical analysis, when to get in and out, short-term versus long-term, right? I'm going to recap that before we jump in to the new education. Before I do, though, it's important to understand that any advice contained in this presentation is general only, so it's not tailored to your personal circumstances. You therefore need to decide for yourself as to whether it's appropriate to you. Just a recap of the first week, if there was anything that was probably the most fundamentally important piece of information that you took away from it, was that in order to be a successful trader, you have to be good at three things. You need to be able to pick direction, you need to have some good strategies under your belt, and then you need to be able to manage your risk effectively. If you can master those three things, then you will make money from the market. So even if you don't do education with us and you're going to go down that road of trying to teach yourself, which I do warn you against. I mean, trial and error can be very expensive when trying to learn the stock market. But at least now you should have an idea of the three main things that you need to learn about. What brings them all together is a set of trading rules. Okay, Tim's going to go through this a bit more later on in the presentation. But again, this is arguably the most important piece of information holistically of things that you need to learn. Right. Last week, we ran through technical analysis. Now, technical analysis, we believe, is a much better form of analysis for short-term trading. So if you're attending this webcast tonight looking to make long-term investments, it's probably not the right webcast for you. But even so, technical analysis and looking at things from a shorter term can help you time your entries better. So I wouldn't discount it. We would say that the short term is perhaps defined as more of a week, days to weeks to a handful of months. Anything beyond that for us is more medium to long term, okay? Technical analysis is really focused around reading charts. So it's about looking at historic price data to help predict future price movements, right? So we basically look at charts, and our charts look pretty crazy if you don't know, if you're new to it. And once we have our charts, we apply basic technical analysis principles, and you can see I've outlined them there for you. Those are technically not all of them, but they're the main ones that we focus on. Trends and counter trends, support and resistance levels, technical patterns, entry and exit signals, and finally mathematical indicators. And we kind of look at it in that order, all right? So there's a bit of a secret there. That's basically how we look at things from top to bottom. To recap that, if we were to take, this is the slides that I used last week, right? The first step would be to draw in our trend lines, right? And to identify a market range. So you can see that this stock is trading in an uptrend, right? And it's defined by higher peaks and higher troughs. The idea here is to draw a trend line that connects the troughs, and we want to connect at least 3 troughs, all right? As you can see, we're touching at least, there's 1, 2, 3, 4 points that we're touching today, after today, right? So 4 points validates this trend line. It's also known as a support level. It's just a support level that has an incline. The idea here is that if the share price was to ever return back to this line, then we would have some degree of confidence that it was likely to rebound. If it doesn't rebound and it breaks through, then that itself can be an entry signal for a bearish trade. We can also potentially draw a line up here to define our range. Next, we draw in more traditional support and resistance levels to define a more close-knit, tighter range, right? So you can see historically, the share price has rebounded from roughly this level here, You can see it bounced there, maybe back here throughout this period. And it was also a resistance through this period. So another important point would be that support and resistance levels can swap just depending on where the share price is in relation to them. The resistance level here is also quite rather key. It's got resistance there. You can see the stock's gone up and turned around, and it's done so a couple of times here in the past as well. You don't have to be too precise with your support and resistances or your trends or your counter trends, etc. It's about getting a general idea, trying not to go through too much price data, and just putting these basic principles on the page so that we can start to build an image of where we think the stock is going. Once we've done that, we try to identify patterns. This is a very simple ascending channel, right? You can see these two parallel lines are going upwards, so it's a channel, but it's rising, so it's called an ascending channel. Very simple. Don't know why that's there. And then finally, we look at our entry signals. So with an entry signal, we always like to look at today's bar, right? The open is on the left-hand side. The high is the highest price that the share has traded at during that day. The low is the lowest share price that the share has traded that day. And the close price or the current price if the market was open. When we look for an entry signal, we want to see the close much higher than where the open is. In fact, if we took this vertical bar and we split it into thirds, we would want the close to be in the top third and we want the open to be in the bottom third for a bullish trade. In addition, we would want to see continued buying power over at least a day or so. So the previous day, we want to see today's range have a higher high than the previous day and a higher low than the previous day when looking for a bullish trade. If we're looking at a bearish trade, it would be the opposite. Finally, the only thing left to do would be to confirm with our indicators. So this is the stochastic. This is only one type of indicator we use, and I am going to run through an actual, I'll give you a trade idea tonight after I've gone through a bit more education. And you'll see my page is a lot messier. I've got a bunch of other indicators as well. But this is just one indicator that we like to use, and I would say it's fairly simple to understand. It's called the stochastic oscillator. You can see that I've highlighted in the green areas the overbought and oversold area. Obviously, the overbought area is up the top and the oversold area is at the bottom. Now you can set the time frame for these stochastics to whatever you want. We've got our own settings that are more tailored towards shorter term. And you can see it's telling us in the short term that this particular stock is oversold, right? It's oversold, and when the stochastic is starting to come out of it and they're pointing up, that's a positive sign. And the fact that they've crossed over also indicates a change in direction, right? So there's a bit of a process there, and I'm trying to highlight that process to you because at the end of the day, it's often a rookie mistake to actually start by looking at your indicators. A lot of beginners, when they come to us and they learn from us, they fall into a very easy habit of looking at your indicators first. Instead, you want to look at your trends and counter trends, your support and resistance levels. You want to look for patterns in your entry signals. And then really only at the end, you want to confirm with your indicators. And if they confirm it, then that's great. So that was a very quick rundown of technical analysis, right? Once you've got an idea of to what stock you want to trade, you've applied these principles and you've gone, yep, okay, this stock looks bullish. I want to trade it. You can always just go buy the shares. Of course you can, right? But we think there's better ways of doing it. And that's what we're really going to be focusing on tonight. When we trade, we like to trade derivatives. Now, derivatives are something that you may have heard of. They may not be what you've heard of. You may not have heard of them, I should say. And if you have heard of them, you might be a little bit confused by them. You might be a little bit scared of them. And all of that makes sense. Hopefully by the end of tonight, you'll have a better understanding. You'll have a bit more confidence in learning these types of things so that you can actually apply it to your own trading. Two types of derivatives that we like to trade, as I mentioned earlier, are mini warrants and options. And the reason we like to trade these is because ultimately both of them give us more flexibility. When you trade stock, the only strategy that you have is buy low and sell high, which is obviously a lot more easier said than done, but even so, it's still just one strategy. But the market doesn't always go up, does it? I mean, March this year, it tanked, right? Over the last 3 or 4 months, it's been going sideways. So if you're going to be a trader that's trading regularly, right? You're buying and selling actively. You're trying to generate an income stream, trying to take regular profits. It doesn't make a lot of sense in my mind to just have one strategy, right? It would be great to be able to trade all those other market conditions as well, wouldn't it? The other thing that not a lot of people recognize, which is worth taking note of, is that if the only tool you've got in your toolbox is a hammer, then everything can start to look like a nail. And what I mean by that is if your only strategy is to buy low and sell high, then I would say it's fair to say that you're going to analyze the market with a bit of biasness. You're going to want to find bullish trades, right? Because that's how you make money. Your brain goes, well, I need to find a bullish trade because that equals money, which makes me feel good. So I feel like you're going to have a biasness. Now, I'm not a scientist, I don't know, but it seems to make sense to me. Whereas if you can trade bullish markets, bearish markets, sideways markets, bullish sideways, up and down, sideways and down, if you can trade all these different types of strategies, then you don't care what the market shows you. You're not necessarily hunting for a bullish trade. You're just hunting for something that identifies as a trade. And so I feel like you'd approach it with a lot less of a biasness. Now, I'm going to run through mini warrants, and I want to explain to you what leverage is. Leverage is something that, again, if you don't know what it is, if you do know what it is, you've heard it before, but you've never approached it yourself, it can be quite scary because ultimately it means that you can make more money, right? Using less amounts of money compared to stock, but you could also lose more money compared to stock as well. Right? So it provides you a great advantage of being able to use less capital to trade, right? If you're using less money to enter positions, then you can enter more positions. But if you don't know what you're doing, well, then you're in a bunch of trouble, aren't you? And I kind of equate it to driving a car compared to walking down the street. If you buy some stock, right, and especially if it's a blue chip company, let's say you're wrong and you don't really know what you're doing. Yeah, you can trip over and you can graze your knee and you can survive it because you can hold that stock for a very long time, and theoretically over time it should go up, right? So just like walking down the street, not a huge risk. You could trip over, you could scrape your knee, you could walk down a wrong alley maybe. All those things, those risks are there, but I wouldn't call it a huge risk, right? Whereas using leverage and using derivatives, that's more like driving a car. It can get you from A to B much quicker than buying and selling shares can be, in my opinion, right? But if you don't know what you're doing, then you're most likely going to crash and burn, right? If you get into a car without having driving lessons, if you get into a car without having a driving instructor at least hold your hand for the first few times, if you don't study first, pass tests, get a license, if you don't prove to the government that you've actually educated yourself and practiced first, then we don't license you. And the reason is because not just for your safety, but for other people's safety as well, you can get yourself into trouble. And that's the same. I think that's a good analogy for stocks versus more sophisticated trading. But to basically explain leverage, I've got a little chart here, and I'm going to show you how mini warrants essentially work, right? Let's say the current share price is $32. And let's say the mini price is $3. So in one option, I can go and buy some shares at $32. In another trading account, I could go buy mini warrants on that share, call it, let's say it's, I don't know, BHP, and they might cost me $3, right? So in one circumstance, I'm buying BHP shares for $32. in another circumstance, I'm buying BHP mini warrants for $3. Now, if the share price goes up 50 cents, the value of the mini will also go up 50 cents. You should already kind of hint at what I'm talking. You should already be able to see what I'm talking about, right? Just from that slide alone, but we'll keep going through it. If the share price goes up $1, the value of the mini goes up $1, right? If the share price goes down 50 cents, the mini warrant value goes down 50 cents. And if the share price goes down $1, the mini warrant value goes down $1 as well. But the difference here is the percentage gains and losses. So if the share price goes up 50 cents, well, if you had bought the BHP shares, you would have made 1.56%. On the other hand, if you had bought BHP mini warrants, you would have made 16%, right? Because 50 cents of $3 is a lot more than 50 cents of $32, right? But that also means that if it goes down, instead of losing 1.56%, you're now losing 16. Equally, if it goes up $1, with the shares, you make 3%, and with the mini, you make 33%. If it goes down $1, you lose 3%. With the mini, you lose 33%. So what this should highlight to you is that you can essentially make more money with less capital by using mini warrants. But it also means that you can lose more money. And therefore, it's something that you need to learn how to do properly. You need to practice first. You need to have a great deal of respect for. Now, the great thing about mini warrants is that you can trade them on our market, right? So you could go buy BHP shares, or alternatively, if you guys have got trading accounts, I'm almost certain that you could go on your trading account tomorrow and go buy mini warrants. You don't need a special license. You don't need a special trading account. You don't need to open up an account with a dodgy company in Cyprus. You can mini warrants are tradable on our market. It's like buying shares, right? So you have access to these, but please do get educated first. The other cool thing about minis is that you can actually trade them on currencies in our market. So for example, right now, as we speak, our company has a trade recommendation running on the Australian dollar versus the US dollar. And our clients who entered that trade traded it in their trading account through the Australian market. They didn't have to open up a Forex account, right? They bought a mini warrant on the ASX that gave them exposure to the Australian dollar versus US dollar. You can also trade commodities. Gold is a very popular one. Silver is a very popular one. I'm sure there's people online who have been doing their research who probably have some kind of long-term view on gold and or silver, right? Well, we right now have a position on gold. We have a mini long that we put out to our clients that's still running, and our clients who got in were able to speculate on gold futures using mini warrants through our market. They did not need to open up a futures account. I mean, these are just some commodities, by the way. You can trade a whole bunch as well. You can also trade overseas indexes. So instead of buying overseas shares and the rest of it, opening up an overseas account, all that type of stuff, you can, again, buy mini warrants through our market to get exposure to overseas indexes, okay? In addition, you can trade them on about 194 ASX-listed stocks, all right? So, I mean, there's heaps of stuff that you can trade mini warrants on, all right? Now, one thing that I haven't really gone through is kind of from A to Z how to put one together, and that's what I want to show you tonight as well, right? I thought it would be kind of cool to just do a kind of a live trade, give you a trade idea as well. This was, in fairness, looking a little bit better when I saw it at about 2 o'clock this afternoon. It has changed a little bit, but for the sake of the presentation, we'll go forward. If I was to apply my technical analysis on Oz Minerals, the first thing that I would want to do is draw a trend line in. And I would draw something like this. I've got at least 3-4 touch points going through. the next step would be to draw any counter trends in. After that, it's to draw in support and resistance levels. There's probably a bit of a support, I would say, here. And I would say there's a bit of, that would say that's the next key resistance all the way up here somewhere, about $15. Might make these lines a little bit thicker, just in case someone forgot their glasses. Now that I've drawn my trend lines, I'll see if there's any patterns that I can identify. And there's at least a couple of patterns that I can see. The first is a pennant, a broad pennant pattern. It's defined by the uptrend line and the counter trend line. Today, we broke out of the pennant pattern, okay? When you see a breakout of the pennant pattern, especially when you see an increase in volume, it's actually quite a bullish entry signal. The other pattern I can see is an ascending triangle, which we're still trading in. It's defined by the uptrend line as well as the resistance level there. The reason why is because whilst the stock has been trading in this uptrend, it has failed to get through $15 on several accounts, okay? So generally speaking, the trend wins, which is self-evident. It's the trend, right? If it didn't win, it probably wouldn't be the trend anymore. So generally speaking, the trend wins. Do you expect it to break? Do you want it to break? Well, are you going to trade it with the expectation to break? That's completely up to you. We typically don't teach beginners to do so. But if you're more aggressive, then if you want to set your profit targets at a higher level, you're welcome to. The trend is on your side, right? And the trend is your friend is a popular saying. Next, I want to look at my entry signals. Now, again, at 2 o'clock, it was looking much better. The close was, or the share price was actually trading higher, which would have fit the entry signals. Right now, I would say that it doesn't really. I wouldn't say that they're in opposite thirds, but we are seeing a higher high and a higher low, which is the first day of the move. So we are seeing buying come in. You can see over the past few days, it has certainly maintained some bullish sentiment. The only thing that's left to do would be to look at my indicators. The first is the stochastics. You can see they're still pointing up, which is good. You can see there was a bit of a few hiccups there, but ultimately still pointing up, which is just nice confirmation. It's also broken through the 50-day moving average, which was acting as a resistance level throughout this period. It's that really faint green line. I'm sure it's very hard to see. But it's broken through that today, which is also a nice little bullish entry signal. So overall, Oz Minerals spells bullishness in the short term for us. Now, if you did want to trade it, you could use a mini warrant. And we've got our own little mini warrant calculator. I'm just going to refresh this page because it's probably timed me out. So if you want to become, if you jump on membership, if you come along to our education courses, you get membership as part of it. If you just want to jump on membership, we can have a conversation about that as well. You get access to these calculators, and one of them is for mini warrants. Excuse me. So looking at Oz Minerals, I'm just going to choose the first mini warrant, which is OZLKOD. I'm going to come down here, type it in. I know the price because I looked it up earlier is $8.20, but it was might not come up. $7.79 was the last price, but I know it traded higher. It was pricing up higher than that. And then it's up to you to define your risk, right? If you do 500 contracts, you're looking at about $4,100 risk. If you do 1,000 contracts, you're looking at $8,200 risk. How much risk you do is obviously up to you. What I do want to define here, though, is that this is the current share price, right? Should be roughly, yep. This is the current share price, and we're looking at 2% increment higher, 4%, 6%, 8%, 10% increments higher in share price. And inversely, we're looking at 2%, 4%, 6%, etc. share price lower. The columns are the dates, so that's today's date, Unfortunately, it's written in American style. That's 2 days from now, 4 days from now, 6 days from now, 8 days, etc. If the share price goes up to roughly that $15 level, that's a 4% price increase. It's a 4% share price increase. But with the mini, you make 7% profit. Now, that might not be good enough for you. You might be a trader that's used to much more leverage. Fair enough. As a beginner, maybe you don't want to be as leveraged. If it goes 10% higher, you make about 17%. So if the share price goes up 10%, instead of making 10% profit, you're actually making 17%. Right? I picked the $15 level because typically we teach our clients as beginners that you want to be able to make your profit to resistance. And for me, resistance is $15.05. The reason why you want to make profit there is because despite the fact that you're trading with the trend, you can't guarantee that the share price is going to break through that level. In fact, the last 3 or 4 times it's gotten to that level, it has come down. So it makes sense to try and be out by that point. In this circumstance, you're making 7%. That's not enough for us to put this out as a trade recommendation, right? It's not enough for a lot of our clients as a trade recommendation. When we're seeing that type of movement, we usually want to be making like 20% minimum. If that's too rich, that's fair enough. As a beginner, I can understand that, but that's typically what we're looking at. It's around roughly 20% in that type of movement. So let's say you were happy with this trade, you would use this trading platform or whatever trading platform, and you could buy and sell it, right? Provided the market was open. Alternatively, you could call me up and you could say, Caro, I've seen a trade that I'm thinking about doing. Can we just go over it real quick? Would go through the chart. We could always do a screen share. I can take a screenshot, send you how I'm drawing my lines, etc. Have a conversation about picking direction. Then we could talk about what trade you're looking at doing, what strategy you're looking at doing, by the end of the conversation, if you still wanted to place it, you could again go and trade it online. That's totally fine. Or I could place the trade for you. So that's basically it from A to Z. The only thing that's left to do after that would be to manage your risk, right? And that's the next section. I'm going to run through options trading first. I'm going to run through options first, but Tim will go through trade management. So what to do once you're in a trade. Now, options are, we don't teach to beginners, by the way. So if you're learning to trade and you're still relatively new to it all, we don't suggest you go out there and learn options because they're complicated. And the reason they're complicated is because they're the most flexible instrument that you could possibly trade on this market. So you can trade bullish movements, bearish movements, and sideways movements, right? With mini warrants, you can trade a bullish position or a bearish position, right? With mini warrants, they're capped risk. There's no further margin calls. They have inbuilt stops. They're great for beginners. They're great for beginner traders, right? They have a few choices of leverage, right? What I mean by that is that in this example, I actually picked the most leveraged mini long, but there's less leveraged mini longs, right? And there's some choices of mini short. So if you wanted to go long, you'd have maybe 5 choices. Or if you wanted to go short, you'd have maybe 5 or 6 choices, right? And that's varying per stock. With options, you've got way more choice of leverage and way more choice of strategy. Investors, if you're on tonight going, well, to be honest with you, I'm not super interested in trading options. You may be interested in using them in conjunction with your portfolio. One good way to get into options is to look at things like covered calls, right? That's a really strong introduction to a lot of people who have a bit of experience buying and selling shares or investing in shares, but want to dip their toe into the more trading side of things. Covered calls are awesome. If you haven't heard of covered calls, if you have a share portfolio on the Australian market and you have blue chip shares, like you have household names like CBA, BHP, Wesfarmers, Orica, whatever it is, if you've got blue chip shares in your share portfolio, have a look into covered calls. The way that risks works on them is totally different. I think they're really, really cool. I think it's a great way to increase the yield in your portfolio. You can use them to purchase stock at better prices. You can sell them at better prices as well. And you can also use options in conjunction with your portfolio to insure against market falls. So when our market starts to look toppy, which some people get a feel for, some people don't, you can buy insurance. So you can insure your portfolio like you can insure your car. And you don't have to do it through some expensive structured product where you're paying some broker a stupid amount of money for no good reason. You can do it just by buying put options. How to do it properly is tricky, something that we can help you with. That's why we're options experts. But if you've got a share portfolio and you're not that interested, or maybe you might be interested in trading, at least have a look into covered calls and using options in conjunction with your share portfolio. Right? Something that we can definitely talk about. So what is an option? Now, I don't want to spend too much time here because it's not super important to understand this, but I felt like I'd be doing you a disservice if I ran a webcast that had stuff about options if I didn't actually tell you what they were. So if this goes over your head, that's totally fine. There's clients who have to hear this several times for it to kind of start sinking in. But it's not important to you making money, right? I want to say that right now. Understanding how options work doesn't mean you make more money. It's actually got kind of nothing to do with it, all right? But I'm going to give you a brief explanation as to what options are. Please put your thinking caps on and focus here because it's going to require it if you've got any hope of understanding them, right? So options are a derivative. We know that. What a derivative means is that it derives its value from the underlying stock. So if a stock goes up or down, so does the value of that option, right? So you can trade options on heaps of different types of stocks. You can trade them on CBA, BHP, AGL, CSL, a lot of stocks that, again, are household names you can trade options on. And as the share price of CBA moves, so do the options value of CBA options, right? So the CBA options get their value from CBA's share price. Okay, does that make sense? Yeah, I'm just one moment. There are two types of options that you can trade. There's a call option and there's a put option. There is no third option. There's just call options and put options. And you can do some serious wizardry with just these two instruments. Call options increase in value when the underlying stock goes up. So if you buy a CBA call option, you will make money if CBA goes up. Put options, on the other hand, are the exact opposite. They increase in value when the underlying stock goes down. So if you buy CBA put options, you'll make money if CBA share price falls. Everyone with me so far? So already you can see that as traders, this is already kind of cool because I can buy a call option and make money when the stock goes up and I can have leverage. Or I could buy a put option and make money when the stock goes down. So if I have a bearish view on CBA, I can buy a put option and make money when the stock goes down. A call option, well, options as a whole are a contract between two parties, right? A buyer and a seller, or a buyer and a writer is another way of saying it. So if you said to someone, I bought some shares on BHP, and they said, what are shares? You would say, well, shares are, by definition, they're part ownership in a company. So by buying these shares, I have part ownership in BHP, which means I'm entitled to part of its profits. That's the definition of a share. It's boring, it's dry. Everyone knows what a share is. The definition of an option is a contract. It's an agreement. That's what it is. It's an agreement between two parties. But an agreement written on a piece of paper can be worth something. And here's why. The buyer of a call option has the right to buy the underlying stock at the strike price during the life of the option. They pay for that right. The writer of a call option, or the seller of a call option, takes on an obligation to sell their stock at the strike price during the life of the option, and they receive a fee to take on this obligation. So every option has an expiry date, right? So it could be now to the 22nd of October. It could be now to December, late December. It could be now to mid-June next year, right? There's set expiries towards the end of every month. And your option lasts for as long as that month. A call option gives you the right, if you buy it, to buy the underlying stock at the strike price between now and the expiry date of the option. Which means that if you're buying something, that means someone's selling it to you. And from the seller's perspective, they actually have to sell you their stock if you ask for it at the strike price during the life of the option. But because they're taking on an obligation to sell you their stock at the strike price, they receive the money, right? When you buy something, you pay for something, right? That money goes to them. They receive that money. They take on that obligation, right? Clear as mud, I'm sure. A put option is the exact opposite. Again, it's a contract between two parties. It's an agreement. The buyer of a put option has the right to sell the stock at the strike price during the life of the option. They pay for that right. Put option sellers or writers take on an obligation to buy the stock at the strike price during the life of the option, and they receive a fee for taking on that obligation. So if I buy a put option today, right, let's say I buy a CBA put option with a strike of $75, I have the right to sell my CBA shares at $75 between now and, let's say, December. Which is awesome, because if CBA share price falls down to $10, which it won't, but let's say it does, I can still sell my I can still sell my underlying shares, my CBA shares, at $75 if I want to. And the reason why I have that right is because I paid for it in the first place when I entered the contract. The seller has to take on the stock. So the person who sold me the put option, they got given money, right? I paid them money. But it also means if I exercise my right, they have to buy my stock at $75 if I tell them to, between now and December. To put this in another way, just visually, because sometimes you have to hear it a couple of different ways. And again, if this is kind of going over your head, I totally understand. Even as I explain it, it sounds like mush, to be honest with you. Even as I explain it, it sounds like that. It's honestly, when I'm teaching options, I'll do a whole hour just on what we've just talked about, right? But we don't have that time tonight, unfortunately. But again, I just thought it was necessary to tell you what an option actually is. So to put it another way, again, it's a contract. The terms of a contract, because every contract has terms, doesn't it? The terms in this scenario is the right to buy CBA stock at $76 between now and December 29th. So, right, the buyer essentially pays a premium to the seller. That makes sense, doesn't it? When you buy something, you pay for it. So you're paying money to someone. By doing so, you gain the right to purchase CBA stock at $76. And you have that right up until the 29th of December. That's awesome if CBA goes up, isn't it? Because let's say CBA share price goes up to $100. Well, you get to purchase CBA at $76. The seller or the writer of a call option, they're going to receive a fee. They're going to receive some premium from the buyer, right? Maybe it's $4 a share or something. They take on the obligation to sell CBA shares at $76 if the buyer exercises the option. And that obligation lasts until expiry. So the writer of a call option actually wants the share price to fall, don't they? Think about it. If CBA share price is $50, is the buyer going to exercise their right to purchase CBA stock at $76? Why would you pay $76 for CBA shares when they're worth $50? If CBA share price never goes above 76, then the writer gets to just keep that premium that they were given at the start of the trade. A put option is the opposite. So instead of the right to buy stock, the term is the right to sell stock at $76 for the life of the option, which is the 29th of December. So the buyer of a put option agrees to pay the premium to the seller, right? They pay a fee. When you buy something, you pay for it. That makes sense. This allows the buyer to sell their CBA stock at $76. The buyer has the right to exercise the option anytime until expiry. So from now to December 29th, I have the right to sell CBA shares at $76. In order to have that right, I've paid a fee. Let's say it's $3 or $4 per share. The writer, on the other hand, receives the premium, but they're receiving money. So for receiving that money, they're now taking on an obligation to buy CBA shares at $76 if the buyer exercises their right. And that obligation lasts until expiry. So the buyer of the put option wants CBA to go down because if you think about it, if CBA share price falls to $50, well, they have the right to sell their shares at $76. So they get to sell their shares for $16 more than what CBA is actually worth at that time. The writer, on the other hand, obviously wants the stock to go up because if the CBA share price goes to $100, why would the buyer exercise their right to sell their shares at 76 when the share price is actually worth 100? If they want to sell their shares, they'll just sell them on the open market for $100, CBA's current share price. Make sense? Now, again, if that didn't make much sense, that's totally cool. We have a course that will teach you that. I run a webcast every Wednesday at 12 o'clock for my clients, and I spend half an hour going through education, and I do that every week. It's stuff that takes time to learn. But because options are complicated, it also means they're super flexible. So I mentioned earlier that you can trade any market condition, and I virtually mean it. With spread trading, which is when you use multiple options, you use calls, puts, you buy calls and sell calls all at the same time, right? You could be placing 2 to 4 to 6 legs at any one time, right? Generally not 6, it's a bit overkill, but anywhere from 2 to 4 options at one time, you can achieve some pretty cool results. You can do strategies where you make money if the share price goes up or sideways, right? So if a stock is holding a key support level or it's grinding higher, you might, instead of doing a trade which just relies on bullish movement, like say buying shares would or buying a mini warrant would, you can use an option where you make money if it just goes sideways. So if it's grinding higher or it's holding a key level of support, not really going anywhere, you can make money from that. Equally, you can do the opposite. If a stock is holding a key level resistance or is just grinding lower and slowly over time, right? Instead of buying a mini short, which is purely based on directional movement, or shorting stock, which I think is a very bad idea, you can do an option strategies where if it falls, great, you make money. But if it doesn't, it just goes sideways, you also make money. You can also do a trade, which it makes money if you get bullish movement or bearish movement. So if you get enough bullish movement or enough bearish movement, you'll make money. That sounds like a pretty cool trade. To be honest with you, though, it loses on sideways movement. So you have to get bullish movement quickly, or you have to get bearish movement quickly. So it's good to do when a stock is about to become volatile. Guess when we use that strategy the most? We use it the most around reporting seasons. So a couple of days before a stock is due to report, we'll do that strategy because we have a feeling that the share price is going to move like 5 to 10%. And if we're right and the stock moves 5 to 10%, we make good money. right? We just don't care if it's 5 to 10% up or 5 to 10% down. We don't care because we make money either way. So it's a really good strategy to use around reporting or when you think the market's going to head into a very volatile period. And finally, you can do a trade which is purely sideways movement. You give yourself a nice big broad trading range and you say, as long as the stock stays between that resistance and that support level, between now and expiry date, I make my maximum profit. So you've just got tons of flexibility with option strategies. To be honest with you, whilst the market's been going sideways over the past few months, which strategies do you think have been working best for us? I'll ask you that. Now, what I want to do is pass it over to Tim. I've gone way over time. I got a bit carried away. I'm very sorry. It happens. I'm going to pass you over to Tim, and he's going to basically cover off recap on what we've talked about in some ways. He's actually going to give you some trade examples, bringing together the education that I've just run through with you. He's also going to touch on trade management as well, which is obviously the next part of the puzzle.
Okay, thank you very much, Caro. Caro's done a fantastic job of explaining mini warrants and options there. And look, honestly, guys, it's not something you're going to understand in a webcast, right? If you just get tonight that there is other products and other ways of trading the market, if that's all you get out of this webcast, then fantastic, right? You're not going to fully understand how calls and puts work in options. You're not going to fully understand how mini warrants work. We're not giving you that information. What we're good at doing through our courses and through our support, though, is breaking down the complexities of options in a way, in bite-sized pieces that over time they will make sense. And honestly, for me, when I was first learning options, I remember it actually took at least 3 or 4 times of somebody explaining to me what an option was before I really comprehended it. And once you understand what options are and you understand the pricing model a little bit behind it as well, it's kind of amazing what kind of strategies you can build utilizing them, right? But what I will say, guys, is options can be extremely leveraged, right? And it gives you the choice of leverage as well. So you have to be smart about it. You don't just go out there, and I honestly, please do not just go out there tomorrow and start trading these derivatives, guys, right? We're not showing you them to say, yep, just go out tomorrow and do it. We're showing you the power of them, but they have to be respected, and you need to learn. You really got to get educated on, when to get in, when to get out. Make sure you've got the 3 pillars, and we've spoken about this through the whole series here. The 3 pillars. These are the 3 foundations you have to be good at to make money out of the market. That's picking direction, which Caro's done a fantastic job of going through some technical analysis there. But once again, we've only shown you pieces, right? There's strategy, which you can use a mini warrant, stock, you can use an option, and then there's risk management as well. So, and that's what I really want to sort of go through a little bit more in detail now. So as I said, there's a few different ways you can approach it strategy-wise, right? You might be just more comfortable buying stock, and there's nothing wrong with that. Generally speaking, people buying stock, they're going more long-term, right? Because if you're going short-term, there's better ways about it, right? There really is. And you accumulate when you think the stock's cheap, and you only profit from upward movement out of stock, as well as dividends, right? They're the main ways that you'll use stock, is more that sort of medium to longer term views. Obviously, if you're into micro cap, small cap, you might be more on the short term. But and then you got mini warrants, right? So mini warrants can be used more shorter term to medium term, right? I know people that hold mini warrants for a whole 12 months, so there's nothing wrong with that. And they can be, you can choose. The great thing there is you gain a little bit of flexibility. You can trade the market moving downward or upward, right? So, if you think the market's going to pull back, you've got to trade, and it's going to help you find more opportunities in the market. Mini warrants offer you leverage, and you've got a whole different levels of leverage you can choose from there, right? The trade that Caro showed you before in Oz Minerals, the leverage was fairly small, okay? But you can really get much higher leverage mini warrants out there as well. So, there's plenty of opportunity there. The difference there is, the big difference is you don't get a dividend, right? You can't get dividends in derivatives, right? That's the biggest difference between stock and derivatives. Derivatives are more built for trading, okay? That's what they're there for. Options can also be used in a portfolio, as Cara scratched on before. So there's things you can do there, like covered calls, and you can hedge your portfolio using options and things like that too. But options are just so flexible, guys, right? And there's so many different market conditions you can trade them in. I'm going to show you a few strategies we've done recently and a couple that we're in right now, just to demonstrate some of the flexibility you do gain using options. Then the next big thing is risk management, right? Risk management, you only want to be using a set percentage of your bank on any one trade, right? I've heard and I've read too many things on Facebook that people, just newbie traders, jump out straight away, throw like 40K onto one little small cap or micro cap stock and just wipe out half of their bank in one hit. Just don't do it, guys. Whether you're trading stock, whether you're trading derivatives, whatever you're doing in the market, don't put all your eggs in one basket. You never, ever, ever do that. And it doesn't matter how convincing your advisor, your friend, your mate at the pub, somebody on Facebook is, even the best investors and traders get it wrong sometimes. All right. So you never, ever, number one rule, you never, ever, ever put all your money on one trade. You just don't do that. Every trade you go into, you need to be setting stop losses, right? There's got to be a level where you're going to admit you are wrong. Then also with your profitable trades, and this is why we set profit targets and measure how much money we're going to make to resistance, as Caro showed you earlier, is because we want to make sure if it hits that resistance level, I'm going to make more than if it breaks through my stop. And I want to demonstrate to you why that's important as well. Okay, so what I'm going to do, there's a few things I'm going to do from here on. So a few important things I'm going to show you. Before I step into the trades and show you some trade examples, I want to show you some examples here on why risk and money management is so, so important, okay? And why we spread our risk over a number of trades, not just one trade. I just want to demonstrate this. So in front of you here in Excel, I've built a little bit of a model here. And assuming we're starting with a 40K bank, look, I'm not saying you need 40K to start trading, guys. You can start as small as 5. I know people starting with 2. I've got people starting with 200,000. Right? It just ranges so much, right? So don't stress. All right, you can start with whatever you want. I've just used this as an example. So in this example, I'm going to do 10 trades and I'm going to divide my bank up by 10% per trade. Okay, that way, if I want to, I can go up to as many as 10 trades at any one time if I choose to do so. I don't suggest you do that. I suggest, especially as a beginner, if you are a beginner, start with 3 trades max. Don't go over the 3 trades, guys. You've got to be able to manage what you're in. And if you're new to this, don't stress yourself out. So how we make money out of the market as traders, right? It's not getting all the trades right. That is for sure, right? I just want to knock that straight out of the ballpark right now. I do not get all my trades right. That just doesn't happen. The best traders of the world and our most successful traders we have on our books do not get every trade correct. What we aim for is 60 or 70% of our trades correct. Anything above that is cream on the top, okay? 60 to 70% of our trades correct. So what I have here is I've got a 70% win-loss ratio, right? I'm winning 7, losing 3 trades. And what you'll notice through here, all my wins are anywhere between 15 to 20, 30% profits, right? And then all my losses are capped around the 20% mark because that's how I kind of work it, guys. And that's what we teach in our courses. But you never close out perfectly at 20, right? By the time you get in there, sometimes it's a little bit more, sometimes a little bit less, right? But this is just for a demonstration purpose. So by controlling those losses and making sure they're nice and small, I'm able to still make some good money, right? I've made 3 losing trades out of 10, right? Done 10 trades, lost 3, won 7, and I've made some money. Perfect. I'm happy. Let's keep going down that track because if I keep compounding that after a while, so I'll put $4,000 on each trade, but guess what? After those 10 trades, I can put a little bit more. I've now got 43, so I add 10% on, I start compounding, right? And that's how, in the long run, we can slowly, steadily make some money out of the market. But let's just say, I'll show you another example here. Which one was it? was this one here, for instance. Using the same sort of win-loss ratio, we're losing around 24%, winning around 25%. Even if I've got a 50-50 split here, half of my trades right and half of my trades wrong, I can still make some money, right? So I haven't done well in picking direction, but guess what? I'm not behind, am I? So that's interesting. So if you've got a good set of technical rules, they're going to give you a better probability of 50-50. Well, technically, as long as I follow this, I'm going to either break even or make some money, right? So, this is the thing, guys. All we're aiming for is maybe 60-70% success rate. Let our profits run higher than our losses. Now, I'll show you an example of bad money management, right? And in this example here, the person hasn't followed their stops. Now, they've got a reasonable win-loss ratio. They've won 6 trades, lost 4. But in this scenario, they've run their losses too high. Look what happens. All of a sudden, the end result after 10 trades is a loss. But what this also means, guys, if I drop one of these to a 100% loss, guess what? I've still got $36,000 trading bank. If I drop 2 of these to 100% loss and do something really stupid, I've still got a $34,000 trading bank. But if I didn't split my trade up over 10 trades, guess what? If I lost 100%, I'm gone, I'm out of the game. Or if I lost 50%, well, hey, my bank's only 20 grand now, isn't it? So there's 2 things that I'm demonstrating to you here. One, split your trades out, right? Split your bank out over as many trades as you can, okay? Depending on what you're trading and what you're doing, and your size bank will just depend on how that looks. Okay, if you're a smaller bank, well, you're going to probably be using 20% of your bank and only doing 3 trades, right? But nonetheless, whether you've got a 2 grand bank or a 100 grand bank, you've got to sit down and work out, okay, what's the best percentage of my bank that's going to work for me, and what am I doing, and the rest of it. Okay, I'm not saying 10% is the number. I'm not saying 10 trades is the number. But what I am saying is you've got to have a plan here. Okay, you've got to look at it objectively, set something in stone and say, they're my risk management rules. That's how I'm going to manage my risk. I'm going to try and cap my losses at around 20%. I'm going to let my profits run more than that. And look, sometimes we make 50-60% on a trade, right? That happens too. So, it can differ. But what I'm going to show you here is, I can flick through, and I'm hitting F9 on my screen here, and what it's doing is it's randomly changing these P&L numbers. And what you're going to see is, as I'm randomly changing them, the figure down the bottom here changes as well. So, 7 wins, 3 losses. I'm making 10% on my money after 10 trades. That's pretty good, right? If I keep flicking through, I'm making 12% because some of my profits are a little bit larger, but I've still got 3 losses there. All right. Once again, 3 losses. By that time, I made 8% on my money. That time, I've got 4 losses. I'm making 5% on my overall bank. So you can see here that the win-loss ratio is kicking anywhere between 60 to 70%, sometimes down to 50%, and I'm okay. Right? I'm doing all right. And that's the thing, guys, because sometimes you have months like that where you get quite a few of your trades wrong. And then other months you have a ripper of a month. I've had a whole year, quite a long time ago, but we had a whole year of recommendations where we did not have a losing recommendation. That was a wonderful year. The whole year it trended straight up. It was so easy to pick. It wasn't funny, right? But other years you might have a horrible year. And this is why the money management is so important, okay? Is because if you come out of a bad month, you're still going to come out with a trading bank. If you don't stick to your stops, if you don't stick to your technical analysis and stick to your strategy management, you're going to come out blowing yourself up. And this is why we demonstrate this stuff. This is why we talk about this stuff. And this is why we educate people on this stuff, because it's just so important. I can't stress it enough, right? So you've got to have a plan, guys. Honestly, I hope that demonstrates a little bit more about how money management is so important, okay? And when I say money management and risk management, there's 2 things to take into consideration is how you're going to split your bank up over a number of trades, okay? Whether it be 10% of your bank over 10 trades, whether it be 20% of your bank over 5 trades, because, you're going to run out after 5 trades, okay? So, you're going to work that part of it out, and that's completely at your discretion to work out. Okay, so I'll come back away from that. Now, every time we enter a trade or put a trade recommendation out to our clients, we're running through those three exact foundations. We're picking direction using technical analysis. We've got a set of rules that we run through. We haven't shown you all those rules through this three-part webcast. We've shown you the basics of what we do. We don't have to show you everything. So what I want to do is just run through a little bit about and give you some examples on how that comes together and what that looks like. All right. So Woolley Parsons, now this is a trade I showed you last week. Okay. And in fact, we closed that trade today, or the last few clients that were in it closed down today. So we got into this trade back here. Why did we get in? Right? Because the trend was up. You can see that clearly. We had a period of sideways just below the resistance there. So you see an uptrend coming into an ascending triangle. That triangle broke to the upside. Okay. And you can see there that, you know, this blue line here wasn't really a strong enough resistance to really worry us. We're more focusing on that next level up just below $11 there. So we thought, okay, well, it looks like it could easily head back up towards those levels. You know, we had a nice big bullish day, as Caro said, opposite thirds, and everything's pointing up in the right direction. A little bit of volume there on the breakout too, which is always nice to see. This is the recommendation we put out to our clients. That's the code for the mini warrant, that particular mini warrant. That was the strike. All minis have inbuilt stops. We haven't really explained that properly. But what we suggested to people was risking around $3,000. And the reason why we suggest a certain number is depending on how leveraged the trade is, sometimes we might suggest risking a lot less. Okay. With this particular trade, we wanted to make sure we made reasonable money up around that sort of 1075 level. And that's why we suggested that amount of risk. Okay. And how we work that out, by the way, guys, is via the mini warrant calculator. So you see here, we're risking just under $3,000 on the calculator. And we can see here, this is dollar value profit and loss as the share price moves up or down. Okay, so what we're aiming for is a move up near 1060, 1070, $11, somewhere around there. And so 1060 is about a 8% movement in share price. That's going to make us $550 on our 2,800. If it goes to 11, we make about 800. And then, you know, it's at your discretion whether you want to beef that up or not, or pull it back a little bit, whatever you're comfortable with, right? But what we're analysing and what's mostly important here is, okay, where do we think the share price is going? Well, we think it's going to go up to, you know, 1060 or $10 or $11. Something around there is where we believe it's going. Go back up to the chart, and that resistance up there is around 1060, 1070. Around that. And you can't quite see it there, but just take my word for it. Okay, so that's why we picked that as a profit level, and we're happy to make anywhere between 500 to you know, what did I say, that $800. Okay. The other thing is, where do we want to be proven wrong? Where are we happy to say, well, you know what, this trade's not doing quite what we thought it was going to do. Where do we want to place our stop? Well, have a look through here. There's a cluster of peaks through here. It's formed quite a strong resistance just near the $9 mark, hasn't it? Okay. Now, one thing with an uptrend, if you do get a pullback in the trend, it tends to hold key levels of resistance for support. So we chose to put our stop in there because if it drops below $9, it's safe to say we're probably wrong and it's going to head back down to $8 again. So we set our stop in this example at $9. And you'll see that when we put out a tech stop at $9. Okay. Now, the other reason why we're happy to do that, because if it hit $9, we're comfortable with the risk of $550. Now, if I bring that into a percentage, so you understand the percentage side of it, if we lost 550 on 2,863, that's going to be 20%. Remember, we want to keep our losses around that 20% mark, no more. So we like the fact that we can sort of go, all right, well, if it breaks that level of $9, which is the technical side of things, then we're also matching in with that round about 20% mark. All right. So you can see that we're trying to keep our losses small. But we've got the chance of making $800 here. So if we can pull in $825, then guess what? We're making almost 30%. Right? So can you see how it's working there, guys, with the risk management? And I'm bringing together all three elements there, aren't I? I've got my technical analysis. I've got a reason to get in. I've got my strategy. And now I'm making sure that my losses and my profits are in the right place for that strategy. And I'm comfortable with the risk to reward there. All right, so they're the things that we'll teach you how to do through our courses. And I think definitely they're the things that you have to learn one way or the other, right? If you're going to go out and trade derivatives, this is the level and the detail that you need to go to, right? And set those stops and make sure you get out, right? Because it doesn't matter what happens after that, okay? I'll introduce you to a concept. And this one concept changed my trading. I heard someone say this about a year into it. And it's the most important thing, right? A winning trade can be a bad trade. And a losing trade can be a good trade. Now, if you win on a trade and you won by not following your rules, that can be a bad trade because that can send you down a path. It will send you down a path of not following your rules. Now, I showed you before on that spreadsheet that following rules is what's going to lead you to making money, because as long as you keep those losses around 20% and you can get those profitability there or above, you're going to make money, right? But if you lose that win-loss ratio, if you don't close the trade when you should, what's going to happen is you'll turn into that person where you'll run the losses to 60 or 70%. Right? And I've seen this too many times before where people stray away too much from those rules and they end up going, oh yeah, no, well the last couple I held and they turned good, but these last 5 losing trades that I've had, they've been disastrous. You know, they end up being 60, 70%. You don't make money doing that, guys. You just don't. As soon as you start getting a run of losses at that and you run them that high, which I've seen people do, and psychology, right? It's all psychology, and that's all we're managing here. By having a strict set of rules to follow, it stops your psychology turning this into gambling. And for me, and I've had this argument with a number of people, trading's not gambling, guys, right? It's not gambling if you've got a strong set of rules that you're following. But if you stop following those rules and you start running losses bigger than they should, you start running profits bigger than what they should, and you stray away from your system, then you are turning it into gambling. You might as well just go to the casino, go red or black. You probably have a better time, a couple of drinks, and call it a night, right? We're not here to do that. We're not. That's not what we do, right? We're not here to gamble. We're here to make sound decisions on strict rules, okay? All right, so what ended up happening here is we actually closed this trade today. We closed a few trades today, guys, by the way. The bullish run in the market this week's been fantastic for us. We've been waiting for this for a while. As you can see, we've been in this trade since late August, so we hate holding trades that long. We love to be in and out for a day or two, but sometimes it takes a while to get the move up. So if I just jump over to my charting, show you Wally, what it's done. So that's where we got in, and that's where we've gotten out today. Okay, so we finally, after a heap of sideways whippiness, we've had the run we're after. We didn't quite get as high as we wanted, right? But we closed out around that 1050, 1060 mark today. And as you'll see on the slides here, a few different clients closed out for a few different prices. Okay, I took this snapshot directly from the trading platform today. And these are different clients' accounts. It's not showing the account numbers. And you can see here, one person had 1,000 of them, sold at $4.90, one at $5.03 and one at $5. So I've just taken the $5 here, guys. If you followed the recommendation, you would have closed out today for $5. We got in at $4.06. You can see that up here on the recommendation. And this is just a screenshot from our member section. Excuse me. You can see here, if you followed the recommendation, you would have made 94 cents. That's $658 on the risk, and that's 22% profit, right? So look, that's pretty good, okay? Obviously, we like to do that in a week, but sometimes, you know, the market goes sideways. That is what it is, right? And that's the thing with mini warrants. They're great when a stock is trending and a stock is moving. But when it goes sideways, well, you're going to be patient, right? You're going to have to sit tight and wait. So the next strategy I want to show you, and this was a very quick in and out trade, by the way. I think we basically held it for a day, expecting to be there for a bit longer, but we weren't, right? But this is going to be an option strategy this time, I'm going to show you. And this particular strategy makes money from a bullish to sideways movement. So it's a little bit of a different strategy to a mini warrant. So remember the three foundations here. You've got the picking direction, you've got the strategy type, which we're talking about now. Mini warrant's a type of strategy. An option is a type of strategy, and this particular strategy profits from bullish to sideways. And I'm not going into too much detail here because it's just going to confuse you. I want to show you tonight what's possible, right? Because that's the first step. Once you see what's possible, then you can go out and learn it. So this strategy, you want either upward or sideways movement. Once again, you can see why we're getting in. You've got an uptrend. It's broken through the ascending triangle. It was looking a little bit better when we first put it out, but it had pulled back a little bit by the close. So I took a snapshot of that after the market because the chart that I had there was pretty blurry. So I just grabbed this and just for demonstration purposes. But when we went out, the share price was a little bit higher, admittedly. All right, but it did one way or the other broke through that ascending triangle uptrend. This is blue scope still, by the way. This was the day after the day before the budget was announced. So there's some fundamental reasons why we liked it as well. But the technicals were there, right? This is what we sent out to the client. So this was the 6th of October. We suggested the strategy is called a bull call spread. Okay. And they're basically the strikes and levels that we've chosen. We've sold that one. We've bought that one to create this strategy. It's a November expiry, and that's all I'm going to tell you. I'm not going to go any further than that. I'll confuse you. But what you'll see here is, once again, we've got a technical stop. We've got a suggested risk, in this case, 4,600, and that's 75 contracts to do that. We've suggested a price and a little bit of discretion. No point going into too much detail there. But this is what you'd get if you're one of our clients and we're suggesting a trade. Okay, so this is a price matrix. It's very similar to the matrix for the mini warrants, but it's for options instead. What this particular matrix is based on is share price movement up or down, and then time. Now, time has a much larger effect on options than it does on mini warrants, and this is where we can make money from it, or we can lose money from time, okay? And this is the big thing. As time goes on, and you can see that's the 6th of October, the 10th of October, the 14th, the 18th, the 22nd, the 26th. Okay, I've cut it off just so it makes it a little bit clearer for you. But what you're seeing here is day by day, if the share price doesn't move, if it goes dead sideways, you're making a little bit of money, right? But where this strategy gets quite kind of sexy, right, is if you get a little bit of upward movement with sideways. If you have a look here, if it goes up to about, say, even 1388, and you hold that for about a week, it goes from a $400 profit to a $600 profit. If it goes up a little bit more, it goes from an $800 profit to a $1,000 profit. So can you see why we're saying bullish to sideways? We're happy for this to slowly grind sideways. The longer it takes to slowly move up, the better the profit's going to be, right? So if it jumps up to 15, we make $1,700, or we make $2,000 if we wait for a bit of time to go by. So that's why we say this is positive. For what we want is bullish to sideways. Because if you get bearish to sideways, guess what? Guess what? We lose, right? So, every strategy is going to have their, profit targets and what we want, where we want them to move, but we always have to manage risk. So if I go back up to the chart again, and we have a quick look at, why we'd use 13 as a bit of a stop, is have a look at where the trend line is. Now, by the time this falls through 13, guess what? It's going to break the trend line. And we're going to be looking at that and going, you know what? Not liking it. The other reason why we've chosen 13.10, we went 13.10, and it's to do with the monetary loss. Because, what's a $1,000 loss on a 4,600 risk? It's around the 20% mark again, isn't it, right? So you'll see a common theme with a lot of our stops, that we're trying to make sure we don't lose too much, But if it does run, we can make a really, really good profit out of it. Because if you actually have a look at where this could move to, and you can't really see it on that chart, I'll just jump quickly across here and show you. If we rewind, and I think that was the day we got in. Okay, if I just zoom out a little bit, I'll show you here. The next really strong level of resistance is at about 1457 up here. Okay, so if we have a look at 1457, back to here. That's what I was after. Sorry about that. Okay, 1442 with a little bit of time, you're making $1,400. So you're making much more than what you would be losing down there. 1,300, it's almost 1,400 there. And if it just kicks up even more, it just gets better and better, right? Now, we're lucky enough to close this trade out today also. Now, we decided to close out a little bit sort of before our overall profit target. And the reason for that is the market's just so whippy at the moment, guys, isn't it? Right? We're 3 weeks away from the election. So we're really sort of, if we can be in the market for a short period of time now, then that's what we want. Okay, we don't want to be in there for another month. So the fact that BlueScope had run up so much, we started to see it sort of hit some resistance levels in intraday, in the very short term, and we just decided to close it, right? So if you did close today, that's a couple of day trade, and you're making $900 or 18% on your capital. So that's not too bad as well, guys, right? For a very quick trade in and out of the market, we're happy with that. Take it, move on. Okay, but that's an example of a strategy that you can make money from a sideways to upward direction. I'm going to skip past Newcrest. I showed you this last week, guys. This is a bull put spread. I'm going to skip past and I'm just going to show you the matrix on this. This is a bullish to sideways strategy, but with this particular trade, it makes a lot more money from the sideways. So I just want to show you that here. Look at the payoff. We're risking around $4,000 here as well. What you're seeing, I'm just going to skip through because we're getting a bit late, guys. There's one more strategy that I really want to show you up next that's super important. And look, the sideways here, have a look at that, guys, right? What we're looking for, in fact, is just for it to hold a level, right? Because even if it falls down a little bit, on expiry day, we still make money over here, okay? So this just demonstrates there is strategies where you've got a little bit of slippage as well. It can drop down a little bit. I'm still making $950 here, and that's not even expiry. If I had expiry up here, which I didn't have on this matrix for some reason, I'm sorry about that, it's my fault. But nonetheless, you don't need any upward movement at all, right? From when you got in, you just need purely sideways and you're going to make some money, okay? This particular strategy, not going to make a lot of money if it shoots high. You can see here it's moving all the way up to 35. I'm only making $1,000. So we've capped our profitability a little bit if it runs up. This is not a directional trade. This is a sideways trade, right? And this is the type of thing you can do with options. You're still going to lose if it falls, but it has to fall a lot, okay? So even if it fell, probably looking at about 4% or so there. If it went all the way down to 30.50, okay, which we've been testing over the last few days, we're only losing about $1,000 on the trade. Okay, so Newcrest, that was a bull put spread. It was set up in a way where as long as it holds above 30.50, we're going to make money out of the market, right? I don't care where it is above 30.50, but I want it there on the expiry of the options. The next strategy, now this is one of my favorites in a sideways market, guys, okay? And what's the XJOB doing? And this is a trade on the index, by the way. I explained indexes on the first part of this webcast series. And basically, the XJO is the top 200 stocks of our market. And you can trade options on it, okay? And what's the XJO been doing since June? It's been in its channel, going sideways between 57.50 and 6,200. Okay, so a couple of days ago, we decided to go out with this. It was actually yesterday, my apologies. We decided to go out with this particular trade. And this is a purely sideways strategy. It's called a short iron condor. All right. This particular trade, we wanted to stay between 62 and 57.75, which was the support and resistance I just showed you. This trade will receive a credit. I'm not going to go into too much detail on that, but we are going to risk about 4,300. Now, if you got the 13 credit there, guys, okay, that means the maximum you could make out of that trade is the 13 times 12 times 10. It's $1,500. So the cap on the profitability is $1,500 on this strategy with a 4 grand risk. Okay. All right, so I'll show you the payoff on this, guys. Okay, and this comes into that expiry there. It's 22nd. Okay, so you can see 22nd was the expiry of the options. And what you're going to see here is as long as it stays between 62 and above 57.75, have a look at what happens on expiry day. We're guaranteed to make that $1,500. Now, what I love about this trade also is it breaks 62, the losses are manageable. If it breaks below 57.75, the losses are manageable, right? We're not going to lose our 4 grand risk unless we do something stupid. Now, we're in full control, guys, and that's what makes this different to gambling. When you go to the casino, if you hit red, if you choose red and it goes black, you lose your money. That's it, right? With this, you've got the choice when to pull out. You can pull out and go, I'm not comfortable with this trade anymore, and lose $150, even though you're risking 4 grand. And that's the biggest difference here. It's the way you approach it, and that whether you're following rules or not, that makes it gambling or not gambling. And there's a line there. There's a clear, defined line between trading and gambling, guys. Okay, trading is a well thought out, set up system that you follow with technical analysis to pick direction. You might be a fundamentalist that wants to pick direction that way, and that's fine too. Okay, but you've got a reason to pick direction, right? You've got a reason to get into the market. Then you've got a strategy. Okay, you're either using options, you're buying stock, you're using mini warrants, you're doing whatever, right? You might be buying ETFs. Okay, whatever floats your boat, right? And then you've got risk management, right? And even people that buy stock for long term have got levels where they say enough's enough. I'm wrong on this stock. It's time to get out. And that's the difference, guys, right? That's the massive difference here. Now, options can make things very interesting, right? In that you can do so much with them. And I've just shown you a few examples of what you can do with options tonight. I've shown you, a directional strategy that also makes money if it takes a while to rise. I've shown you a strategy where I don't need upward movement at all. I just want to stay above a certain level and go sideways. And now I've shown you a strategy that as long as the channel pattern holds, we're going to make $1,500. And it just has to hold for 2 weeks. 2 weeks from today. It's Thursday. Yeah, 2 weeks from today. It has to stay between those two levels and we make money. At any point between now and then, we might stop out and say, nah, the market was a bit too positive than I thought, right? Or, nah, the market's starting to dump off. Donald Trump tweeted something stupid about stimulus again last night. Looks like the market's going to have a prolonged fall. We might decide to stop out, and that's okay. That's trading, right? So look, I hope that demonstration really sort of highlights this, and I'm harping on it, guys. I've been harping on it for the last webcast. I'm harping on it on this webcast. I can't stress how important this is, right? Especially if you're going to use leverage. Okay, if you're going to use leverage, especially, you've got to have these 3 elements in your trading system, right? You're going to have a reason that you think the stock's going to move. You're going to have a probability of getting that direction right more times than not. Strategies, what they do for you can, especially using options, give you a much heightened probability of success. Because as you can see there, we can set up strategies that are better suited for the market conditions. If we believe the market's going to be sideways and choppy and whippy, we're better off not buying stock or buying mini warrants. We're better off doing the short iron condor I just showed you. But when the market breaks out and starts trending again, guess what? That short iron condor is not a great strategy anymore. We want to be using back to our mini warrants and more directional option strategies. And this is where strategy is important. We can switch around depending on the market condition, right? And that market condition varies. It always varies. And as Caro said, if all you've got in your toolbox is a hammer, then all you're going to see is nails. But all of a sudden, if you've got sideways strategies, you go, okay, well, the market can go for 6 months sideways. I'll go back to 2017, right? It did the exact same thing. All right, if I go all the way back here, okay, through 2017, it went sideways all year. And then what it did, it broke out and started uptrending. Okay, so guess what we were doing through that period of time? You know what I mean? We were doing short iron condors. When it broke out, we stopped doing short iron condors, right? So, and this is the thing, that the market changes. So it does go from a period of strong sideways movement. Have a look at that. It does it frequently, doesn't it? And then all of a sudden you get these big movements. And this is where, if you've got the different strategies under your belt, you can quickly swap and change. You go, oh, hang on a second, the mood of the market's just completely changed. Time to close out all my directional trades and start going sideways again. Or I'll close out all my sideways trades and go more directional again. You've got so much more flexibility knowing more than one strategy. And then risk management, right? I've shown you an example of how important it is to make sure that you spread your money across various trades. Don't put all your eggs in one basket. I've shown you the importance of having stops, because if you let your losses blow out too much, you're going to have to work a lot harder on your profitable side to make money, aren't you? Where if you can keep those losses small and get out quickly, then you can keep your profits, right? Okay, that sort of brings me to where I wanted to conclude, okay? I will hand you now back to Caro, and we'll then wrap a few things up. So we've got a few questions on the board as well. Do we want to answer those now, Caro, or wait to the end?
Well, we can answer them now, I guess.
Do CMC markets have mini warrants? I would assume so, Clinton. I'm pretty sure they're a big enough platform to do mini warrants. A lot of the smaller new fintech guys don't do them. But yeah, I'm pretty sure CMC would do them. Okay, historically, what has been more successful, puts or calls? Look, I don't look at that. I don't look at options that way at all. What's been more successful, put or calls? Because we can use puts to build a bullish trade, and we can use calls to build a bearish trade, right? So it's not really what's more successful over one or the other. We don't really look at it that way, I suppose. Caro, would you add anything else to that?
Yeah, so it's funny because, yeah, when you first learn options, calls usually mean you make money when the stock goes up, and puts usually mean you make money when the stock goes down. But whether or not you use calls or puts is irrelevant to making money if the stock goes up or down, as Tim said. So you can't really say which one's going to do better than the other, to be honest.
Can I use ComSec to trade covered calls? Does the brokerage eat into the income? Absolutely, it does. That's part of doing business, guys. Honestly, trading is the cheapest business you can ever have. Trust me, I've run restaurants before. The rent gets pretty expensive, guys. Staff, not to mention electricity, gas, food, and everything else that comes with it, with insurances and the rest of it. Can I tell you, the little bit of brokerage you pay on trades and a little bit of monthly ongoing to get live data and stuff like that is just nothing, guys, right? Absolutely nothing. It's peanuts in comparison to running a business. So, look, don't get hung up on brokerage too much when it comes to things like that, because as long as you're making some reasonable money, and obviously it depends on your size bank and the rest of it, and you're going to sit and run your numbers, but it's the compounding effect of covered calls that gets important there. If you can slowly grow your bank, even if it is $50 at a time, $100 a time, $300 a time, whatever size bank you're able to do your covered calls with. It depends on, obviously how bigger you're holding in stock, the more income you can get. Eventually it doesn't matter as much, right? So what I do know is ComSec, it's very hard to get an options account, I've heard, at the moment. They've cracked down a little bit. Maybe they've loosened up, I don't know. But since the big pullback, I know they were very selective on options accounts. We're still very easily opening up accounts, guys. So if it's something that you're having problems with, just give us a ring. Oh, look, there is no best broker, to be honest. Like the question is, RE Comsec, who is the best broker to go with? It depends on what you're looking for, right? So for us, we're a full service trading desk, and that's where we're different to Comsec, for instance. If you call us, we'll give you, I guess, a bit of a rundown on what we believe the stock in the market could do next. We'll help you pick your strike. We'll help you manage the trade. If you get exercised, we'll give you a ring and have a chat to you. If it's expiry day and we think you're going to get exercise, we'll give you a call and just make sure you want the exercise. There's plenty of service that comes with us, but we're a little bit more expensive than Comsec, right? If you just want an online platform where you don't talk to anybody, but you want cheaper brokerage, you go with something like Comsec, okay? It's up to you. And a lot of the fintech guys that are coming out at the moment, like Superhero, they don't do many warrants and options. They only do stock, okay? So they keep it very, very simple. Yeah, look, it comes down to what you want, right? You want a bit of service, you're going to pay for service. If you want that online experience where you're doing it all alone, well, that's your Comsec, right? You're not going to, I think you can call Comsec and they've still got people but they won't give you any advice on the market. They'll just simply place your order in, and that's it.
And it's expensive as well.
Well, they're not that much cheaper than us anyway, right? That's for sure. We're a little bit more.
Over the phone, it's more expensive. If you get them,
actually, if you call them up, they're more expensive than what we are.
We actually covered this in the first webcast. So part one, Tim spends a good amount of time talking about different types of brokers. So if you wanted more of a deeper explanation, go back and watch the recording. It's about halfway through to 3/4 of the way through that Tim actually runs through that in a much deeper fashion.
Yeah, absolutely. Then the other question there is, do options get traded on smaller cap stocks? Unfortunately not. You find options are on roughly the top 70 stocks on our market. So mini warrants is about 200 stocks.
We're putting together a covered calls course. Did you mention that?
Oh yeah, sorry, I missed that question. I'll let you cover that.
So we run an options course. In fact, Tim, you may as well flick me the screen.
Yeah.
Because what you have been talking about is literally on my screen in some ways. And to answer the covered calls thing, I'm going to run through that in a moment. But thanks. Yeah. It's just my slow computer, unfortunately, or slow internet. But the cover calls course. So we do run an options course that teaches you how to trade, and what we're putting together is a covered calls course where we don't teach you all the other trading stuff. We just teach you covered calls. We used to run one a while ago, right? But it was kind of distracting us from our trading. So we kind of stopped running it. And now what we're going to be doing is basically an online offering where we, kind of have like a virtual classroom in some ways, and take you from A to Z, what a covered call is, how to trade them, what stocks are good to do them on. We'll give you a set of trading guidelines in some ways that we can help you kind of tailor to your own circumstances, to know when to get in and what type of stock to do the cover calls on. We're actually literally in the middle of doing that. I did some work on that today. I'm sure Tim did some work on it today, and so did Sam and a couple other people. So it's something that we've already kind of got the material for it. We've been doing it for a very long time. We used to run a similar kind of course in the past, but we're just updating it for a more kind of modern scene where you kind of can do it online, because with COVID, obviously people can't travel. We're in Melbourne. We're not allowed in our office. So we're just, updating that course for more of an online focus, and it should be ready. I don't know, Tim, you can answer that one. I don't know. Hopefully within a month.
Look, obviously, with COVID going on and stuff, we're now live streaming our face-to-face courses, being in Victoria and all. It's going really, really well. Actually, the response has been great because everyone in state, they don't have to travel to come down to do one of our courses anymore. They can just do it for the comfort of their home. And Carlo's doing a fantastic job of it. But it's given us the idea of moving more towards a lot more online education. So this particular covered call course, it won't be live streaming. It's going to be more pre-recorded videos and written content, but we're going to give service with it. So you can actually call Caro, myself, Sam, Ben, any of the guys on the desk if you've got a question, right? So, but yeah, look, we'll probably be ready. I'm really hoping in the next sort of 3 weeks, right? But these projects sometimes can end up being a little bit longer. What it comes down to with us really is how busy we get on the desk, right? So we go through months, especially when the market whips around sideways, where we have a bit more time to build things and do things. But once the US election kicks in, guys, I've got a feeling we're going to be very, very busy. So I really hope to have it out. So
yeah, same going into Christmas as well. Like, it's funny. Did ask a question before, like, what do you think are the type of strategies we've been doing in the current market? And the answer is time decay strategies, or strategies that rely on sideways movement. But because they're time decay strategies, that just means you're waiting for time, and you're literally waiting. So yeah, we've had a lot of time on our hands, and as Tim said, it'll kick up at the end of the year, hopefully. But yeah, look, I want to run through courses in a brief bit, but Tim was talking about brokers. On your screen, you can see some of the main bullet points as to what our trading service is like. So if you're looking for a good broker, you're welcome to call us up or email us and open up a trading account. It's free. It's free to maintain. It's free to close. Where it's not custodial. So if you've got shares, it goes on HIN, which protects you. Your money goes into your own personal bank account, doesn't go on our books like it does with some CFD providers, a few sketchy other people. If you'd like to do that, you're welcome to. We trade options, minis, and shares. We can get you access to potentially IPOs, hybrids. We're very sophisticated. We're all about providing you full service, right? If you want to go trade online, do no contact with anyone, that's fine. We're just probably not the right people for you. If you want help with your trading, if you want access to different markets, if you want more sophistication, then we're probably the right guys. What makes us different is that we focus. Sorry, Tim.
I'll just say one thing there. We do online trading, by the way. We do also offer that.
Yeah, sorry. Yeah. I didn't mean it in that way. I just meant more that we do online trading for sure, but what highlights our business is the service that we provide.
Yeah.
Even if you don't use it, which you will, but even if you didn't, it's good to have someone backing you up. If you're trading options and you get exercised, you want to have someone in your corner that knows what they're doing. And there's a lot of people out there who don't know what they're doing. A lot of brokers, But anyway, what makes us different as well is that we don't receive individual broker commission. So I don't have an incentive for you to trade. My paycheck doesn't change. I'm on salary. If you do more trading, great. If you do less trading, fine. Doesn't affect me, right? So I don't have that conflict of interest that a lot of other brokers have. In terms of education, some of you have asked questions about that over the last few sessions, including tonight. With our education, it's kind of 3 steps. You learn, practice, then implement. We have a couple of different courses. We have a beginner's course that focuses on technical analysis, mini warrants, and risk and money management. On the left here, we also have an options course, which we don't really suggest beginners doing, right? You want to get good at this stuff first, as Tim has really kind of been harping on tonight, that we've been really harping on in the last 3 sessions. You want to get good at those 3 things first. If you feel like you've already got that under wraps, you're welcome to come and just do the options course. It's up to you. Either way, whatever course you do, we run paper trading competitions. You get your own personal trainer. You have access to our members area where we give you trade recommendations. We give you training videos. Every day, Monday to Friday, 12 to 1, one of us runs an online trading seminar. We go through the market. We look for trades as a group, right? Tim runs his on a Tuesday. I run mine on Wednesdays. I go through the market for about half an hour, look for trades, talk about what's going on, and then I spend the next half an hour doing options education. and the other advisors get their day of the week as well. So I think that's pretty unique to our business. If you can't make those 12 o'clock sessions, they're recorded and placed on the website that night. Basically, it means every day at 12 o'clock, you get to go through the market with an advisor looking for trades, right? That's good for implementing. It's good for practicing. We'll also provide you with the technology, right? We'll give you the trading platform. We'll give you the options calculator. We'll give you the mini warrant calculator. We'll give you all the technology there. And of course, you have the advisors, right? So you can talk about your strategies and pretty much everything that we've talked about tonight. So those are the services that we provide. If you're interested in any of them, if you want to learn how to trade, or if you just want to open up a trading account and trade with us, you're welcome to. Give us a call, or you can email us and we'll get back to you. What will be the cost of the covered calls course is something that I don't have an answer to. I'm not sure Tim does either. I'd be scared to say anything on anything that's officially recorded. So I don't know if I want to answer that question. Price is usually the last thing that you kind of consider. You get the content built, see how much value is in there, and then you go to market with a fair price. We actually don't make money from our education, believe it or not. It's a gateway to trading with you. So if we can help you become a successful trader, then you're likely to continue to use our services. You're likely to continue to trade through us, and therefore it's about mutual success. Education is just a means to an end, as it should be for you as well. So the covered calls course you can expect to be priced very fairly. Well, that's the end of the questions. All right, well, it's way past my bedtime. I'm sure it's past some of yours.
Look, guys, if you do want to get involved, we just invite you to have a conversation with us, right? So we've got, Caro, Jared, you can talk to, and just have a chat to see where you're at, what you're up to with trading, whether you're experienced or whether you're a beginner. And, then we can talk more about how to get involved, right? Whether membership's something, whether it's just straight out trading through an account with us. It costs nothing to open up an account with us, guys. Whether it be doing one of our courses. There's many things we do offer through Trader Circle here, guys. And, it's not something we like to just blurt out over a webcast. It's nicer to have a conversation and go, okay, well, where you're at, what are you doing, what are you trying to achieve, and how best can we help you with that? All right. Our next beginners course, for instance, is on the 24th, 25th. If there's anyone sort of thinking about that, don't hesitate, because we'll have to stop taking enrollments in that by mid of next week, purely because we're going to send manuals out. And we can't 100% rely on the post at the moment. So we're trying to make sure we're sending manuals out at least a week and a half before the course starts. Being with COVID and everything, even I think one particular manual took 2 weeks a little while ago. So we're just trying to make sure we can get manuals out in time, right? So look, there's that opportunity. If you want to get involved with us, just give us a ring, or just even the chat box now, just write book, and I'll make sure one of the guys give you a call over the next few days.
Yep. And again, thank you very much for joining us tonight. It's almost 2 hours. It just goes to show that you guys are obviously serious about learning this stuff, which is fantastic. To spend 2 hours listening to Tim or I is a feat, I'm going to be honest with you. Again, if you've watched the other past couple of sessions, good on you for making it through the 3 weeks. I hope you learned a lot. If you didn't catch them, again, the recordings are going to be sent to you tomorrow, and always feel free to review them and give us a call if you want any clarification.
All right. Fantastic, guys. Once again, thanks a lot for listening in, and I hope you all have a great rest of the week, and bye for now.
Bye for now.